Assalamualaikum and hello everyone. This is the video number 4 on Mfrs 102 inventories, and this session is going to focus on the net realizable value test for raw materials and recognition of recognition of inventories as expense. So let us look at what is provided under the Mfrs 102 relating to the raw material and other supplies. The NRV test of the raw material and other supplies that are held for use in production. So here the raw materials and other supplies that were used in a production process, normally by the manufacturing entities, as to be transformed into finished goods, are not written down below the costs if the finished product in which they will be incorporated into are expected to be sold at or above cost. So let's say the selling price is above the historical cost, the selling price of the finished product. Therefore, the net realizable value for the raw material and other supplies used in the production shall not be based on the resale value of the raw material. This is because they are not held for resale in the ordinary course of business. So the manufacturing business here is not trying to sell the raw materials or the supplies. They're trying to sell the finished product. So therefore, the raw materials and supplies are not items that are held for sale in the ordinary course of business. However, it is to be consumed in the manufacturing process. And therefore, the raw materials, in terms of the NRV of raw materials and other supplies, will be assessed at historical costs of the finished goods. So let's look at what we have here to see the guideline given under Mfrs 102. If the finished goods could sell at or above historical cost, meaning that the selling price is way above the historical cost of the finished goods, therefore the raw materials and other supplies shall not be written down. So there will be no write down of the raw materials and supplies if the price or the selling price of the finished goods are above or at the historical cost when they are being sold. However, if the finished goods could only be sold off below historical cost, so let's say they are being sold off below the historical or the cost of the finished goods, the raw materials and other supplies shall be written down to the net realizable value. So here it has to be written down. In this case, for example, happens when there are a decline in the price of the raw materials, which indicates that the cost of the finished products exceed the net realizable value. So the best measure of the net realizable value for the raw materials that has been mentioned in the Mfrs 102 is the replacement cost. So if there is a replacement cost, the net realizable value will be measured at the replacement cost, as that is the best measured that were mentioned in the standard itself, paragraph 32. So let's look at this example to illustrate that particular net realizable value tests for raw materials and other supplies. These are information related to MN Oberheide as at 30th June 2006. Take the textbook, and that is at page 263 of the textbook. Go and check your textbook. Thank you. Historical cost of raw material is 5,000. So these are the historical costs of the raw material, 5,000. And the replacement cost of the raw material, which is the best measure for the NRV or the raw material and supplies, the net realizable value test, is 4,000. And there are some conversion costs that are needed to process or to produce the raw material into the finished product A. So the finished product is finished product A. There are some labor costs and production overhead that has to be incurred to arrive at the cost of the inventories, the finished goods. So you're required to calculate the value of the closing raw material if the finished products are to be produced, which is A, expected to be sold or to fetch at 10,000. We will see what is the historical cost of the finished goods by calculating them. And the second one, if it is expected to be sold off at 6,500. So what you need to do is first to calculate what are the historical costs of the finished product A. So that will comprise of the raw material. Remember, raw material will be absorbed or will be used to manufacture product A, and labor cost, production overhead. So therefore the cost of the finished product A, the cost or the historical cost is 8,000. However, the historical cost of the raw material is 5,000, right? So let's look at how do we decide whether or not the raw material should be written down or should not be written down. So according to the MFRS, if you look, the historical cost was 8,000. Now the next task is to find out what are the selling price of the product A. So here it is informed that it could be sold off at 10,000, which means that this is actually at or above historical cost. So if you look, the historical cost was 8,000 and you are selling at 10,000. So therefore, historical cost of finished product A is 8,000. And that is to conclude that the closing raw material will be valued at 5,000. Why? Because the selling price is above or at the historical cost. Here is above by 2,000. So the closing raw material will be valued at 5,000. Okay, that was, there is no write down of inventories that will be done for the case of the selling price at 10,000, which is above the historical cost of finished product A. Remember, we are selling product A as our ordinary cost of business. Raw material is part of the items consumed to get into product A. The next one is where it is sold off below historical cost, where if you can still recall, that was actually at 6,500. But let's just do this again. Historical cost of finished product A was 8,000. And from the information in the question, I have extracted that the replacement cost of raw material was 4,000. Remember, according to the standard, the best measure of an RV for the raw material is the replacement cost of the raw material itself. Here is 4,000. So let's look at our case here. The finished product now are being sold off at 6,500. That is below historical cost. And historical cost was 8,000. Right. So since it is below historical cost, therefore, the closing raw material will now be valued at the replacement cost, as the historical cost is 8,000 and the selling price is 6,500, where it is below the historical cost of the finished product. So therefore, raw material will be measured at the replacement cost. And as a result, there is a write down that needs to be done by writing down the raw material from 5,000, and that is written down to 4,000 at replacement cost. So the write down amount is 1,000, and that will need an entry to be passed to write down the amount to the statement of profit or loss debit. Inventories here is the raw material. So we are going to go and debit the cost of sale, and we are going to go and credit the raw material, right? So basically that has to be adjusted, as that is now at the replacement cost. So there is a write down here of 1,000. Okay, so the inventory is valued at the replacement cost when that is the best measure. All right, let's look at the recognition as expense. According to MFRS 102, The inventory will be recognized as an expense when the inventories are being sold off. For detail, you can refer page 264 to 265 of the textbook. And when these are being sold off, the carrying amount of those inventories that are being sold off has to be recognized as an expense in the period in which the revenue has been recognized or has been generated. The second one, you can also recognize inventories as an expense when the inventory is being written down, let's say from the cost to the net realizable value. So the recognition of the write down is an expense, and it will be done in the period to which the write down or to which the loss occurs. So on the reporting date, the inventory will be measured at the net realizable value. So this is normally on inventory valuation, and when the write down is needed due to the case where cost is more than the net realizable value. And also when there is any reversal of any write down of inventories. This happens where you need to go and recognize as a reduction in the amount of inventories recognized as an expense in the period in which reversal occurs. And the reversal normally arises from an increase in the net realizable value, NRV, if a company writes down inventory in the prior year, but then the selling price has later increased in the subsequent year. So therefore, the reverse entry must be done to go and restate the inventory. The write down must be restated. Right. Next is the recognition as an expense, the write down and loss of inventory. Under the periodic inventory system, it will be recognized directly in the cost of sale when the closing inventory amount is being valued. Under the perpetual inventory system, the write down is debited to the cost of sale and credited to the inventory with the write down amount. So that was prescribed under Mfrs 102. Let's look at one final exam example to illustrate the write down of inventories and also illustrate the cost of purchase as well as the inventory valuation, whether it is on cost or at net realizable value. So we have Suchi Ayu, a wholesaler of healthcare product, and they have the supplement that were the product of the company for the year ended 30th June. These are the two supplements, which are liquid type and the tablet type, right? And these are the amount purchased, these are the amount sold, right? And there were different figures there, don't worry. And invoice price, which will be part of the cost of the inventory. This will be part of the cost of inventory, right? This will be the directly attributable cost. This is also directly attributable cost. But the NRV is given to you, so the NRV. So these are all per bottle with the exception for the total import duty and handling costs. These are the total for 1,700 bottles of liquid supplement, whereas 1250 and 625 is the total for the 2,500 boxes of tablet purchase, and these are for the purchase numbers that were the figure given here, right? So you need to be extra careful when you go and calculate your closing inventories as required by the question. Determine the value of the closing inventory as at 30th of June using item by item. There are only two types of supplements, so it will be item by item basis. Let's just construct the table first. Before that, recall what are the costs of purchase. Before that, the table, go and create a table for the write down column here, and also one column for the closing inventory, one column for NRA, one column for costs. Here cost of purchase is the cost. Unsold quantity is the difference between purchase and sold, what you have and what you have sold. And recall this again, what are the components of the cost of purchase? And for our case here, the invoice price is given for the liquid bottle, 150 multiplied, and then you get the figure. NRV is 155 per the 500 liquid bottle, and that would be 77,500. However, there are also directly attributable costs, which are the total cost for the 1,700 bottle that were purchased. But we need to go and apportion and find out what are the costs for the unsold inventory, which is the 500 bottles. So that is why it is being apportioned here. Calculation just to show the one that are attributable to the unsold inventories. You have to total up the two handling costs, which is import duty and handling cost, and divided by 1,007 times 500 bottles where they were unsold, and you get this 963.24. And import duties are actually the cost of purchase mentioned under Mfrs 102, as well as the handling costs. The subtotal for this liquid item is 75,693.24, because these are the total that have been added to get this. Next is the NRV. It's just one item that has already been given, and you compare these two, you would see that this is the one that you will measure at, since that is the one which are lower between the cost and the net realizable value. So the cost versus NRV. So therefore there is no write down, nil, no write down needed. So now we move on to the next item, tablet, with the same thing, only that the unsold item is 300 boxes with different invoice price, with different NRV per box. So we are going to go and multiply each of the thing and with the 300. So 15,000, NRV is 24,000. But you still have the costs of purchase, costs for the tablet, which is also to include the import duty and handling costs. Apportion them according to the number of item purchased, 2,500 multiplied with the unsold inventories, which is 300. You get 225. Total up that you get 15,225, which is the result of these two. And then the NRV is still at 224. So again, it is measured based on costs. So the value of closing inventory is based on costs. There are no write down. So as an answer, the total closing inventory will be this, plus the one that you have in the previous slide, that is this. So if you total them together, you will get the figure 92,188.24, and there is no write down at all. In terms of the conclusion or the advice, in accordance with Mfrs 102, state the standard that were related here, the information on lower of cost and net realizable value, the valuation of inventories guideline. Hence, the value of closing inventory on the date 30th of June will be recognized at cost. No write down is necessary. So no write down will be made. Next, these are the final exam questions from FAR210. So you can look at the question which involve purchase of fitness equipment, and that was purchased, being reconditioned, and later being sold off. And you have the information related to the fitness equipment, and the question will need you again to do the valuation of inventory. Of course, you need to find out what are the costs. You can do it yourself. I'm just briefing this. And what are also the net realizable value. Look at the component of the cost. Component of the cost is clear. It could be just number 1 and number 2. However, the NRV will consider this last 3 items. The cost of purchase is also in the cost of purchase calculation. So number 1. And let us look at what we have here. the requirement. We'll go into detail this part again, right? The you have to describe the fitness equipment. So you need to go and decide whether is it a PPE or is it an inventory. So you know that it was held for use in your records of business. So that is an item of inventory, not a PPE. And that is because they are held for sale on the records of business. The company involved in purchasing and selling the fitness equipment. The fitness equipment are not held for use in supply of service. That is not an operation of a gym whatsoever where you have the equipment as one of the PPE, but that was actually the business of the company selling fitness equipment. So that is why it is an inventory. You ask to determine and advise. When you ask to determine, you need to go and determine what are the value of closing inventory, value of fitness equipment, the inventory that were held for sale as at 31st of December, D20X3. So that is the closing inventory. The assumption for the cost of sale is 20,000. So the cost will comprise the cost of purchase. We do it again. Cost incurred in work done, which is for recondition costs. So those are the two costs. The NRV will comprise, let us look at what are NRV. It is the estimated selling price of the inventory in the ordinary course of business, less any cost of completion and cost necessary to make the sale. So the selling price is 50,000. That was just direct from the question. Estimated cost of completion 7,000. These are for the closing inventory. And the estimated cost to complete, which are all being deducted, both cost of completion and cost to make the sale are deducted from the selling price. Therefore, you get NRE 41,000. And that 41,000 to be compared with 45,000, the cost, the NRE is lower than the cost. Since NRE is lower than the cost, inventories according to the MFRS, shall be measured at the lower of cost and net realizable value. And in our case, NRV is the one that is lower. So therefore, the closing inventory to be shown as a current asset in the statement of financial position is to be measured at 41,000. And 41,000 is the NRV. As the NRV is lower than the cost is higher. So it has to be written down by 4,000, and that write down is added to the cost of sale, debit cost of sale, and credit the inventories in the year incurred. If you were to calculate cost of sale, recall earlier the cost of sale was 20,000. You have to do the adjusting journal entries. And as what I mentioned, debit cost of sale, credit inventory, and as a result, the cost of sale now has to be increased to 24,000 because there was another extra expense to be incurred, which is 4,000 due to the write down. And the last part of the question is in line with the corporate social responsibility. Uphill donated the equipment maybe to a school or maybe to an orphanage center or community center. Here is community center, 5th of January. The equipment, the cost was 1,008. So it's no longer an inventory. It will now be an expense. So what is the accounting treatment? So donation of equipment, since the company has donated the equipment is not an inventory. So it has to be excluded from the inventory list, but it has to be now included as an expense in the statement of profit or loss. So debit donation, expense credit, inventory. Okay, we'll continue with inventory, which is goods in transit and goods on consignment, and together with presentation and disclosure in our next video. Till then, I'll see you, and I will see you. If you do not understand, go repeat, go and replay, pause, and keep on learning, keep on listening, keep on doing what you should. And until then, I'll see you, and I will see you. Assalamu alaikum, and have a pleasant day ahead.